Hey traders, Barry Burns here. Today we're going to talk about how to scale into a trade, and I will give you a one-word answer and then expound on it. So the one-word answer is don't. Don't do it. It's not smart. Doesn't work well. So why not? Okay, so there are basically three reasons. Number one, the reason that most people like to scale into trades comes from a lack of confidence of where they're entering their trade initially. So they don't have a way of discerning what's the best entry to take the initial position. And so they're scaling in because they don't have a real objective rule-based methodology that they have a lot of confidence in that works over a long period of time consistently to get the best entry right out of the gate. And that's what you need. That's the real solution to your problem, by the way, is not scaling in so that as the market does its gyrations, you get, an average price that kind of works pretty good. And if the market keeps going in your direction, you keep making more money. All that comes from uncertainty and a lack of confidence in your trading methodology. And you probably, if that's your case, you have a lack of confidence in your trading methodology because it hasn't been working for you very well. So step one, the big solution really is to know where to enter the market with precision, very accurately, with very small risk, where the market almost always goes in your direction right out of the gate. So you don't have to worry about that. Okay, so by the way, if you're interested in that, I have a recorded webinar. Go to indicatorwebinar.com and you can get that for free. Not only the teaching, but also the indicator that I use to nail cycle highs and cycle lows for my entry. In fact, this is how I enter all my trades. No charge for that, by the way. And I'll even show you how to get it set up on your charts. Okay. So now that's the big problem. So here is the second problem, and that is that if you think about it, okay, so scaling into a trade assumes the market's going to make a big move. But think about that for a second. Markets don't trend most of the time. So it can work okay in trending markets. Even then, it's not optimal, as I'll show you in a minute. But you're assuming the market's going to trend if you're scaling into trades because you're going to keep bringing in more and more lots, shares, contracts as the market continues to move in your direction. And therefore, you've got to have a long-term follow through, a long-term move. But the truth is, and we all know this, that markets only trend roughly 20% of the time. So if markets only trend 20% of the time, then scaling into a long-term position is not going to work well for you 80% of the time, and you're going to get hurt. So for example, here's one example right now. And again, this is more typical of, let's say that, and this could be done many different ways. You might have a different methodology. I can't go through every type of methodology of how people would do this. But just as one example, if you're doing a trend retracement trade, all right, boom, we go down, we go up. All right, so you decide, cool, I'm going to enter here and go short. And then as the market goes down again, whoops, wrong drawing tool. Alrighty. All right, goes down and then comes back, retraces, and starts going down again. So you say, all right, I'll add to my position. I'll add some more short shares, contracts, lots, whatever, because, hey, market's going in my direction. And therefore, I'll add more money to the short side of the trade. And then it goes against you. And wow, goes way against you. So that's the problem. Number one problem is markets only trend about 20% of the time. So it's a trade concept that'll only serve you 20% of the time. And number two, it will not even serve you very well 20% of the time. Okay, so now here we do have a trending market. So market goes up, cool, comes down. Let's say you get in here. All right, you buy here, or you buy down here, this low. Again, we're just going to use trend reversal trades in today's example. All right, so far so good. Well, wait a minute, it doesn't really go very far, but it does make a higher high. But now as it retraces, it makes a lower low. So this is where people who don't have precision tools for entries say, okay, well, I bought some there and now I'll buy some down there. But psychologically, think of what you're doing. Psychologically, you're going to have a challenge. Again, let's just talk about the real world here. So in the real world, you're going to probably, if you're like most people, you're going to think, wow, I don't know about this because I got in here and now the market has, and a lot of people place their protective stop down here. And now it goes lower, and now you start to lose your confidence that, oh, are you going to scale in or are you going to are you going to get out? It's confusing, right? Should I get out because it broke this low? Should I really get in on a lower low? And it leads to confusion. So again, confusion. A confused mind cannot act. We want to create simplicity, not confusion in our trading. So markets are choppier now. That's the bottom line. Markets are choppier now. When this concept was first created of scaling into a trade, that's back when markets did used to trend more. And that's because the markets were slower. That's way before computerized trading, right? The Bible of technical analysis was written in the 1940s. And back then, commissions were high. You had to call your broker on a rotary telephone. Nobody had direct access to the market. Nobody had computers. And so markets just moved slower. Now, everybody's got direct access. Everyone's got low commissions or no commissions. You got high frequency traders, algos, quants, and so markets are choppier, and it's harder to scale into a trade and stay into a trade because they just don't have those nice sine wave type movements, the stair step patterns, as frequently. And even when we have them, they're not as nice and neat and tidy. All right, so that's number 2, numero dos. So the third one, let's switch charts again. Okay, and now in this third one, I'm giving you the best case scenario. This is best case scenario. So even in a best case scenario, it doesn't serve you very well. So let's say that you get into this. All right, and we're going to use hindsight here just to show you the concept. So the risk reward on this is, well, first of all, a risk reward ratio is going to be worse on every time you scale into the trade. Your risk reward ratio is going to be worse every time you scale into a trade. So your very best, highest probability trade will be the first retrace in the trend. That's your risk, and that is your reward. Okay, so got it? Very clear. So when it comes to risk reward ratio, if I had a precision tool to get me in, which I do, and I come in with all of my size here, all my shares, all my lots, all my contracts, then that's my risk and that is my reward. Pretty sweet. And I'm getting that on all the money that I'm putting into this trade. Now, if I only bring in part of my money, and then let's say that I buy and add more to my trade here. Now you got to decide, well, am I going to put my protective stop down here, or am I going to put it all the way down, let's see here, how should we draw this? Down here. Okay, because remember in the last one we showed, it did make a lower low and still kept going up. So, okay, what do you do with this one? If it comes back down and breaks this, would you get out? Well, then your risk is even bigger. But even given that, let's say that you did put your risk there, now your reward is only that. On the third one where you get in, all right, best scenario, your risk would be that, and your reward would be just that. I'm supposed to have those all at the same high there. Okay, so you can see, bottom line is, on each subsequent entry, your reward is worse. So each new trade you get in, number one, it's a worse reward scenario. So you can make money, less money on the shares, contracts, or lots you put in. Number two, with the markets being choppier, it doesn't have as much of a win-loss ratio. And number three, trends don't follow through as much. Remember, the trend is your friend until the end. And what does that saying really mean? What it really means is that, well, it's based on a statistical scenario, that the longer a trend continues, the less probable it is to continue. So each one of these trades, this is your highest probability trade from not only a risk-reward ratio, but also from a win-loss ratio. Okay, because that's earliest in the new trend. Now we're later in a trend. Trend is becoming less our friend, less our friend. So each one of these entries is worse for both win-loss and risk-reward. So why would you do that? Why would you do that? Trading is a statistical game, and you are continually making your trade worse and worse and worse on every statistic possible. So, and then given the fact that markets only trend 20% of the time anyway, really no bueno, no bueno, senor, no bueno, senora, senorita, niños. All right, my friends. So feel free to write your comments down below if you agree, disagree, whatever. We'll always appreciate your feedback. And I got my rubber band trade for you. The rubber band trade is not a trend trade. I give this out to everybody who watches my videos for free. It's my gift to the trading community, and it's an actual complete trade setup. It's actually a reversion to the mean trade setup. And in today's markets, where the markets are choppier and so forth and don't trend as much, these reversion to the mean trade setups actually occur more frequently and work even better now in today's contemporary modern markets. So I call it the rubber band trade. Feel free to get it. Go to rubberbandtrade.com, pick it up. My gift to you, no charge, and give it a try. Test it on a demo account or simulator. I want you to start making some money before you spend money.